Hey guys, so welcome back to the channel. I have another trading strategy which I'm going to backtest again for you for over 100 trades. I'll first tell you about the indicators that we're going to be using, show you a few examples, and then perform the 100 trade backtest on the British pound against the Japanese yen. This strategy involves two trading indicators, the rate of change and the exponential moving average. So the rate of change, also known as ROC, is the rate at which a variable changes over a certain time period. It's a term that is frequently used when discussing momentum as well. It can be defined as a ratio between a change in one variable and a matching change in another. Graphically, the rate of change is represented by the slope of a line. So the Greek letter delta is frequently used to represent the rate of change. It depicts the momentum of a variable and is used to mathematically express the percentage change in value over a specific period of time. The rate of change calculation is pretty straightforward, so essentially it divides the current value of a stock or an index by the value from a previous period. And to get the percentage representation, you just simply subtract 1 and multiply the result by 100. So that's the first trading indicator. The second indicator we'll be using is the well-known exponential moving average, also known as EMA, which is essentially a sort of moving average that gives the most recent data points more weight and relevance. So another name for the exponential moving average is exponentially weighted moving average. So it basically reacts more strongly to recent price movements than a simple moving average, which gives all of the observations in the period identical weight. So this backtest is based on the 15-minute time frame with a 1-to-3 risk-reward ratio. So that means that every dollar that we risk, we aim to make a minimum of $3. Just as a note, this strategy is offline, so that means that I'll go back in time on the charts to test this strategy and see how it would have performed. So it doesn't take into account commissions or the spread. So here's the strategy. So we buy when the rate of change becomes positive while the price is above the EMA, and similarly we sell when the rate of change becomes negative and the price is below the EMA. The second rule is that we place the stop loss at the last swing. The third rule is that we have no maximum number of trades at any given time. We move the stop loss to break even as soon as the profit is equal to the maximum risk that we are taking per trade. And the final rule is simply we must have a minimum of 1-to-3 risk to reward ratio. So let's get on the charts now so I can show you some trades and we'll dive into the 100 trade backtest. Alright, so here we are on the charts with the British pound against the Japanese yen on the 15-minute time frame. So we'll go ahead and add the indicators. So I've got them saved here. We've got the rate of change and the exponential moving average. The exponential moving average is a 200 period EMA with an EMA method, and I will simply change the color to white. It's a bit more visible. And the rate of change is the default settings, but again, I will change the same color. All right, so essentially, when the price is below the EMA and the rate of change becomes negative, we take a short. So I'll show you a few examples and then we'll go straight into the backtest. So there you go, a couple of long trades. The price broke above the 200 EMA, the rate of change broke below the zero threshold, and then back up and it became positive. So we took a long with the stop loss at the last swing and we aimed for a 1-to-3 risk reward ratio. So that would have been a win. Same here, it broke again. You would have gone long here again, right here, here. So there would have been quite a significant amount of long trades, which all would have been successful. In this case here, this would have been a break-even trade because you put your stop loss right here, the last swing. The open profit reached a 1R, which is the amount that you risked, but then the price went down. So you would have put your stop loss here at break-even, and your stop loss would have been hit. And here are a couple of short trades. So the price is below the 200 EMA, the rate of change becomes negative, you put your stop loss at the last swing and you aim for 1 to 3. So the open profit reached 1R, which is how much you risk. So you would have put your stop loss at this level for break even, which would have been hit. However, this second trade, where the rate of change becomes negative again, this price would have been slightly higher with the same stop loss. So you would have hit your 1 to 3 risk reward ratio. And similarly to the last long trade, right here, it becomes negative. You take a short, you place your stop loss at the last swing. So if your stop loss is slightly higher than the last swing, you would have survived this, but then it would have hit your break-even stop loss. It would have been either a loss here or a break-even right here. However, this one would have been a loss because obviously you didn't reach the 1R of open profit, so it would have been a loss hit right here. So let's go ahead and perform the 100 trade backtest, and I'll see you for the results. So there you go, guys, the results of the 100 trade backtest on GBP JPY. So we had a pretty high maximum drawdown of 43%. We were risking 5% per trade with a risk to reward ratio of 1 to 3. We had 51 wins, 31 losses, and 28 trades that resulted in a break even. We had a maximum of 10 wins in a row and a maximum of 4 losses in a row, which gives us a win rate of 64% over 27 days. So the total profit is actually pretty enormous at 3,478.2%. If you had started with $10,000, you would have ended up with $347,821. So of course, this is pretty mind-blowing. But this is due to the fact that we were risking 5% per trade, and obviously if you take 4 losses in a row, you're down slightly less than 20%. At some point we had a maximum drawdown of almost 50% of the account. So the total profit is amazing, but you have to deal with the fact that it's a high risk strategy. You might be down 50% at some point on the account, but when the market is trending, you have 5 or 6 trades in a row that are successful. And since we have a 1 to 3 risk to reward ratio, we're risking 5%, but we make 15% on every successful trade. So in a trending market, if you get 5 or 6 trades in a row that are successful, this is 70 or 80% of your account in profit. So again, this is a high risk trading strategy, so high volatility, but you can see the results for yourself. You know, it's very interesting. So let me know what you guys think in the comments, and I'll see you in the next video.